My name is Impazi Siame, and I will be presenting a comprehensive financial statement analysis on Puma Energy Zambia. We will delve into the company's recent annual state reports to assess its profitability, financial health, and competitive standing. Our data analyst for this project was Mr. Lamek Msiska, and our researchers were Stefan Mlenga, Mr. Moses Chibunga, and Mr. Wes Kumwenda. We used CapCut and PowerPoint to record this presentation. Please note that this is a student project by City Market Solution for Dr. Kaulu's financial statement analysis course at the University of Zambia. The content presented is for academic purposes only and not actual financial advice. Presentation. The overview of this presentation is as follows: the company overview, the quantitative financial analysis, which are the profitability ratios, liquidity and solvency ratios, efficiency and activity ratios, common size analysis of both the balance sheet and the income statement, the cash flow analysis, the earnings quality and red flags, and also consideration of the IFRS versus the US GAAP, and finally we would make our investment decision. We will now delve into the company overview, where we will discuss the brief background of Puma Energy on its industry, key operations, ownership, and its market position. Its industry, with Puma Industry, the industry that it operates in, the company operates within a dynamic and competitive oil and gas downstream sector, which includes the supply, storage, distribution, and retail of refined petroleum products. This sector is crucial for Zambia's economic activity, supporting transport, mining, power generation, and manufacturing. Its key operations are in retail, business to business, aviation, and lubricants. Puma Energy Zambia is owned by Puma Energy Holdings Limited Ireland, which has 75% of the shares. Pension funds also have a 21.18% of shares. Individuals have 2.64% of the shares. Companies, charities, and trusts have a 1.19% of the shares. We will also delve in the type of financial reporting standards that Puma Energy uses when reporting its financial accounts. Puma Energy PLC, as part of Puma Energy Group, prepares its consolidated financial statements in accordance with International Financial Reporting Standards (FRS) as issued by the International Accounting Standards Board. We will now delve into a comprehensive quantitative financial analysis. To begin with, we'll start with the profitability ratios. The decreasing trend in the profit margin indicates that the company has been failing to effectively control its expenses. The gross profit was at its lowest in 2022, suggesting that the company has been struggling with high cost of production, but in 2023 it increased, suggesting that the company has become adaptive to the high cost of production, consequently increasing the company's profit through the effective pricing of its products. In 2024, profit slightly dropped. The operating profit margin declined from 3.8% to 0.29% in 2024, which the inefficient management of resources or high operational costs. There is also a declining trend in the pre-tax from 2022 to 2024, which is a signal to show the company's overall weak financial performance. In 2022, the return on equity ratio of 22.74% was excellent, indicating that the company was efficiently using its shareholders' money to generate more profit. But in 2023 and 2024, the ratios were poor, mainly due to very low and poor profit margins in those particular years. And this was a signal that the company was struggling to generate more profit or have a good return on its investment. We will now analyze the liquidity and solvency ratios for 2022, 2023, and 2024. The high current ratios suggest that the company has ample assets to cover its liabilities, indicating strong financial health and shows lower risks of default, as is the case with Puma Energy Zambia. The 2022 ratio is excessively high, which suggests that the company may have faced inefficient asset management. The quick ratio is fairly high, indicating the company's ability to meet short-term obligations with assets that can easily be converted to cash quickly than inventory. The debt-to-equity ratios high, with 2023 having the highest of 107.94%, suggesting that there is an over-reliance on debt, which can increase the risk to equity holders and creditors, but can also magnify returns when the company performs well. The debt to capital ratio is below 50%, which indicates a more stable capital structure that is less dependent on borrowed funds. The ratio of 51.91% in 2023 suggests that the company relied more on debt than equity for its capital as compared to 2022 and 2024. The debt to asset ratio in 2023 is also over 50%, indicating that a significant portion of the company's assets are funded by debt, while in 2024 and 2022 ratios are lower, indicating that equity financed assets. The financial leverage ratios were greater than 1, indicating that the company is using more debt to fund its operations and assets, which amplifies both returns and risks for a shareholder. We will now move to activity and efficiency ratios. Inventory turnover is very high, indicating that the company is selling its inventory quickly, which can lead to higher profits and lower risks of spoilage. It also indicates strong sales, effective marketing, and efficient inventory control. The total assets turnover is also very high, indicating that the company is effectively utilizing the company's assets to produce revenue, and suggests strong asset management and a good return on investment on the company's assets. The company appears to be in a significant financial distress, particularly in 2024. Key profitability metrics have turned negative, leverage is extremely high, and while some liquidity improved slightly, it is not sufficient to offset the other critical weaknesses of the company. Now we will now do a comprehensive analysis on the common size income statement of Puma Energy. The company has experienced a dramatic and severe deterioration in profitability from 2022 to 2024, as seen on the screen. What was a stable and moderately profitable business in 2022 and 2023 collapsed into a loss-making one in 2024. The primary driver was not a drop in sales but a significant increase in the operating and financial costs, completely eroding the gross profit. Revenue stability is the base of the common size statement with each year indexed to 100%. This means we are analyzing the structure of costs and profits, not revenue growth or decline. The problem lies entirely on the cost side. Cost of sales remained very high but stable over the years, with 96.77% in 2022, 94%, 94.45% in 2023, and 95.61% in 2024. Consequently, the gross profit was consistently low but stable. This implies that the company's core business of selling its products was low margin. However, this was not the cause of the 2024 crisis. A gross margin was similar to previous years. The problem began after the cost of sales was accounted for. The root of the problem in 2024 was the operating performance, a combined category of selling and operating costs, allowance for credit losses, and general and administration expenses appeared to grow in 2023 and 2024, totaling to 4.4% of revenue in 2024 and 3.7% in 2023, which resulted in operating profit being 3.8% in 2022, which was relatively healthy, and 3.7% in 2023, which was also healthy, but collapsed to 0.8% in 2024, indicating it almost completely wiped out a company's ability to generate profit from its core operations in 2024. If operating weakness were the first hit, financial costs were the knockout punch. In 2022 and 2023, financial costs were negligible, but skyrocketed to 1.05% of revenue in 2024, which was larger than the operating profit for the year. The combination of collapsed operating profit led to a disastrous result of 0.5% loss in 2024, with a profit in 2023 of 2.9%, and also recorded a 2.66% profit in 2022. We will now delve in the common size balance sheet for the company. So the company had much higher current assets in 2022 of 68%, of total sales, then 66% of total sales in 2023, and finally 50% of total sales in 2024. However, current liabilities were 41% of total assets in 2022, 47% in 2023, 41% in 2024, suggesting that the company was becoming less and less liquid, which may result in difficulties for the company to pay its current obligations due. We will now delve into the cash flow, common size cash flows of Puma Energy Zambia. So, cash flows from operating activities shows high volatility with a strong positive cash flow in 2022, which dramatically turned negative in 2023, then increased a strong positive in 2024 with free cash. We will now look at the earnings quality and its red flag. The major red flag is that in 2023, the company made huge profits but had a negative operating cash flow. This is a sign of poor earnings quality, as profits were not converted into cash. In 2024, the expected credit loss exploded from 19,000 in 2023 to 142,000 in 2024, suggesting a significant increase in the risk of customers not paying, requiring a large non-cash charge. We will now look at how the FRS and the GAAP treats each accounting area, like revenue recognition, risk accounting, assets, impairment, research and development. So for FRS, it needs 50% collectability threshold, and for USGAP, it needs about 70% collectability threshold. This impacts the investor, affects the revenue trends and comparability with US companies. Different timing of revenue recognition for the investor. And with the lease accounting, FRS uses a single model, GAAP uses a dual model, and it impacts leverage ratios such as debt to equity for the investor. We will now make our investment decision with what we have analyzed in the previous slides. This is not a good investment based on the analysis of this company. 3-year financial performance investing, 1.5 million kwacha at this time is highly not recommended. The company is in a financial distress phase characterized by a severe cash shortage and growing debt. While its revenue growth is impressive, it is not currently translating into sustainable profitability or financial stability. The risk of permanent capital loss is very high. The recommendation is that the investor should wait and monitor the situation. The critical metrics to watch for a turnaround are a significant reduction of the bank overdraft and a positive net cash, a return to consistent profitability after finance costs, a clear strategy to manage its debt load. Until these issues are resolved, the company is a speculative and dangerous investment. Thank you very much.